Congratulations on making it to this point. It's important to not only learn the basics covered in the last video and also the mechanics which are covered in this video, but it is equally vital that you gain experience in using trade credits before you try to fly solo. There are different types of trade credits that can be used in real estate deals, so you will need guidance in the early stages as to which are the right trade credits for a particular deal. Let's start by looking at how the majority of real estate wholesalers currently operate and what the most common problems are. In some instances, it depends on which state you are in, and assignment can be a real nightmare. It's also important to understand how contracts work and whether you are doing double closings, whether you are selling a corporation or an LLC, or just doing straight out assignments. The obvious problems of buying a property are deposit money, financing, and other costs, closing costs such, which are dealt with later in this video. Sellers react negatively quite often when they discover that you are not the end buyer. And also there's cognitive dissonance experienced by buyers when they see how much money you're actually making. There are further issues. One in particular is seasoning. Seasoning is referring to when you buy a property at a discount, you cannot automatically the next day turn around and refinance it at market value, at appraised value. The banks here are the obstacles, and they will not provide finance on the market value if in fact the contract is at a lower value. The next problem that you face is that your profits are taxed as income and not as capital gain. This results in a tax rate of 30% at the lower end and 40% if you're actually making good money. But an even bigger problem is the financial loss that occurs when you forego the profits that are being made and you give the lion's share away to the investor. Now, it is possible through using trade credits for you to not just hunt, cook and watch the investor eat, but you can actually become the lion and you can be the one that does the eating instead of being a pussycat. Here's an example of a recent wholesale deal where an experienced wholesaler was looking at a property with an appraised market value of $400,000. The wholesaler stated as his aim to get the seller to basically give the property away to him at $250,000 and then to flip the contract to an investor for an assignment fee of around $30,000. The before tax profit on that deal for the wholesaler was $30,000, and that'll add on to the cost base for the investor. So the investor has a total price of $280,000 for the acquisition. However, with the wholesaler, That $30,000 is not what he's going to end up making after tax. He's going to lose 40% of it. He's going to lose $12,000, and what he's going to make out of this deal is only going to be $18,000 and not $30,000. So why does the wholesaler flip instead of buying the property and making more money? Well, 90 times out of 100, it's going to be because of finance problems. The wholesaler may not have a good credit rating, and he certainly won't have, in most instances, the deposit, the 20% that's required. This in fact makes the wholesaler 50 grand light on. The financing issues aren't just the 20% though, it's the deposits. And even if a wholesaler has a 50 grand deposit for one property, if he's a entrepreneur, he'll be endeavouring to do more than one deal at a time, which means having a lot of $50,000 deposits to complete all deals, which, as you know, the average wholesaler does not. However, trade credits can provide wholesalers with a bank with an infinite roll of money when you need it. So why not have a host of 50,000 deposits so that you can do an infinite number of deals? With banks, there's borrowing limitations. 80% obviously. Other lenders may lend more, may lend less, but you have to have good credit. If you don't have good credit and you lack the finance skills, then you're not going to be able to obtain money when you need it. Another problem that buyers face is a shortage of lenders on the particular property. If the property is not in good condition, in some instances a lender will not lend against it, or if it's in an area with a high foreclosure rate and other reasons. Another problem that the buyer will face is the interest rates. If you can't get bank loan rates and you have to go to hard money lenders, you can find interest rates of 10% and a lot more, and also there are points on the deal. Now I'll deal with the tax aspects later, although I will briefly refer to them now. The before profit tax on the deal, as we said, is 30 grand. 40% tax element is going to leave the wholesaler with 18 grand. So the after-tax net earnings is nowhere near as attractive as what it could be. One way to actually improve your returns as a wholesaler is not necessarily doing more deals, but making more out of each deal simply by closing your hand on the money that you can make, instead of letting it drain away down the rat hole in tax. Now, when a buyer goes for first mortgage finance, the maximum most lenders will provide is 80%. There's certain exceptions, but in general 80% is the norm. But what they lend on is the lower of the property's value or the contract price. With a contract price of 250 grand, irrespective of the 400 grand market value, the lender will at maximum provide $200,000, which is 80% of the property's contract. However, the investor needs more than $50,000 in cash to do this deal. he actually needs 80,000 because the wholesaler requires 30,000. So the deposit of 50 and the wholesaler's fee makes the actual amount of cash needed 80 grand. However, the percentage lend is not actually 80%, because what is being lent against is the 250 grand, whereas the acquisition cost for the investor is 280 grand. The lend, in fact, is only 71%, slightly over if you're a numbers person. Okay. Seasoning is an extreme problem that investors face. With a 71% lend, there's 200 grand of equity in the property which the investor is unable to drag out. For the investor, the total cost of acquisition is the contract price, which in this instance is 250 grand, plus the assignment fee, 30 grand, which is 280 grand. There's incidental costs on that which we won't worry about at the present time, but the cost base for the investor is 280 grand. Now, how much profit could the investor be making if they sold it at full market value? The profit there is a lot more than what the wholesaler is making. The profit before tax is 120 grand. Now, you're not going to learn just by sitting in the back seat and me doing all the driving. So what I want you to do is to calculate, firstly, what is the net profit that the investor will be making if they were to sell the property in under 12 months, based on 120 grand before tax profit. Did you work out the tax at 40%? The net profit is 72 grand. Now I want you to recalculate, what if the investor sells the property after 12 months? What would be the tax and what is the net profit? Now, money going down the tax rat hole only benefits one person, and it's not the humans, it's the rats. In calculating what the assessable profit is, it's necessary to reference the cost base. So, in this particular example, the investor made 120 grand profit on the cost base of 280. The wholesaler made a 30 grand profit, but has a tax bill of 12 grand. If you add the two together, the 48 grand and the 12 grand, the combined total tax of the wholesaler and the investor is 60 grand. And that is what goes down the rat hole. Now, what if there was a way to save some of the money that's gone down the rat hole? How would you feel if I put my arm down the rat hole and I pulled out 24 grand to give to the investor, and at the same time I pulled out 6 grand to give to the wholesaler? So in total I've pulled out 30 grand, and that's split on the basis of what the relative amount of tax is that each party paid. In fact, what each party is getting back is 50% of the tax that's gone down the rat hole. Now, I'm not going to put my arm down the rat hole and pull out money to give to you unless there's something in it for me. You've got your money that I'm prepared to give you, and whatever else I pull out of the rat hole is mine to keep. How does that sound? Okay. Now, what would your financial position be if instead of netting 18 grand as a wholesaler in this particular deal, you were netting 24 grand? By how much is your take-home money increased? What is the percentage? The same, which we'll do in a moment for the investor, but let's just look at the percentages for the wholesaler. It's a 6,000 increase or improvement in your position over the 18,000 that you are netting at the present time, and that amounts to a 33.3% improvement in your after-tax net position. How would you like to increase your net earnings on every deal by 30%? Okay, now let's have a look at the investor's position. The investor currently is netting 78,000 after tax. But if we give them 24 grand out of the rat hole, they'll be able to make 102 grand after tax. What is the improvement as a percentage in their after-tax position? They've got an extra 24 grand divided by 78 grand gives an improvement of 30.7%. They too can net or can get a 30% increase in their after-tax return. Now, who would you rather be, an investor or a wholesaler? Let's have a look at the investor position if there were no wholesaler involved in this deal. The cash purchase price is 250 grand. The resale at full market value is 400 grand. There are buyers in the market at 400 grand. That is what the valuer has said when they give the appraisal. It is not a dodgy figure, it's a real figure, and it's a figure that lenders will also be prepared to lend on, provided the contract is not discounted. The earnings before interest and tax, it's a accounting speak, EBIT, is 150 grand. The tax is 60 grand, so the potential net profit after tax that goes to the investor is 90 grand. Now, apply the tax savings using trade credits. The profit after tax potentially can be 120 grand. Now, if you're a wholesaler or if you're an investor, you have a competitive advantage in your market. Which would you prefer to do? You can pocket all the extra money yourself. You can give all the extra benefit to the seller so that you can win the property and beat all your competition because no one else can offer the same deal. Or you might share the extra money so that it improves the seller's position. You don't have to beat them down quite so much, and you still make more money out of the deal. There is a tax saving opportunity here for the wholesaler if particularly he's becoming an investor. There's 30 grand of tax benefit that could go to the investor. So, what would you do with the 30 grand? You could use that to pay interest on the property if you purchase that and raised a loan. Remember, we're borrowing here, we'd be borrowing against the 400 grand, we'd be borrowing, let's say, 320 grand. The interest cost, annualised, could be about 15 grand. If it's a hard money loan, obviously it's going to be a lot more. Right? However, you will have the rent coming in as well to soften the blow. In fact, if you add 2 years rent together and the 30 grand, that should be more than enough if you borrow at bank rates to cover interest expense for 2 years and the market is rising. So, who would you rather be, wholesaler or an investor? Does this warrant you altering your business plan? Can you work the numbers? Remember, early on, you were told you have to be able to do 8th grade math. If you can't do multiplication, addition, subtraction, division and percentaging, it's unlikely you'll be successful in the real estate business. Now you might pause the video here, practice some of those numbers and see whether you can come to grips with them. Now you know that I don't advocate longer term holding of properties, but the illustrations that I just gave you is an example of how trade credits can make you into a landlord and how rent can actually help you with the holding costs. Now let's go back to the appraised value of 400 grand, and instead of having a contract at 250 grand, we contract at the 400 grand. That's the true market value of the property, but for some reason wholesalers are left scratching about it, and investors are failing to take advantage of this also. In the first video, I told you that I prefer nice homes in nice areas, and the principal reason is that there's no delay in selling and flipping this sort of property. You can do it instantly. In fact, if you've got a buyer and investor already lined up. That's item one benefit. But there are actually two amazing results. The first is the lender doing the 80% loan on the 400 grand instead of the 250 grand. And the second amazing benefit, there's zero tax if you resell the property at the full market value, that is the 400 grand. Means you've made, on this particular deal, the 150 grand profit, and no tax. Instead of the 200 grand advance that the bank would give you on the 250 grand contract, the lender will now give you 320 grand advanced. You've got an extra 120 grand of finance in this deal. You can pay the seller their 250 grand. You don't need any money yourself to close on the deal, and after the seller's got his cash, there's money left on the table for yourself. Now what could you do with that money? Obviously you've got to pay for your trade credits, but where does it really come from? It comes out of your tax benefit. It comes out of money that's gone down the rat hole. What could you also do with the money? Certainly cover the interest expense for the next 2 years. And like I mentioned previously, you could save the rent. Now if you're borrowing at bank rates, you could actually save the rent for the first 2 years and then apply those to pay the interest for years 3 and 4, so that you would not have to sell the property until year 5. And something that I'll mention briefly, but I don't want you to do, it's only for thrill seekers, and that is after 5 years the property's gone up in value, and the bank would be prepared to do refinancing, so you could drag out extra money that you could then use to to put down as deposits on more property, or simply to service the interest costs on the loan that you've got going. But where might the market be in 5 years' time? How much better off would you be if, in fact, you were to buy the property as an investor than continuing as a wholesaler? What is your full financial potential if you became skilled in the use of trade credits instead of being transfixed and faint-hearted with the idea of wholesaling? How would you like to profit like a lion instead of a pussycat, which the tools of trade credit provides at zero cost? This, in fact, enables you to level the playing field with those people who do have money to do deals. For you, you can do deals and hold property for 5 years without contributing 1 cent out of your pocket at any time. It effectively is cost-free to you. The cost base of the property, 400 grand. On-sell the property at that price. There is no recorded profit because the price that you bought at is the same as what you sell at, and there is no assessable income other than the rent you receive, which would be negated by the interest expense. If the property is sold for more than the 400 grand, more than the cost base, then you will pay tax, but only on the amount of profit above the 400 grand cost base. Now, there's a lot of people I know that have been watching this without really any intention or desire to get in there and have a go using trade credits. There's been a few tire kickers, not that many, I'm pleased to say. There's some time wasters. I have no time for time wasters. There are some people frightened of their own shadow, so they're certainly not going to do anything. If you can't make your mind up, if you're indecisive, obviously you're not in, right? What I want are people who can stand up straight and people who are prepared to start today. Now, can you make a decision on your own? Or do you need to ask an accountant, your spouse, or someone else? Because if you do, this is not for you. I'm not interested in people who cannot make their own decisions and are not decisive. In the next video, there are 2 varieties of trade credits that I'll be dealing with. I'll also go into more detail on the costings and how you can offer sellers an extra 100 grand for their homes without it costing you a cent. Now, how do you proceed now? Firstly, you need to advise that you wish to become associated in one of 3 ways. As a client, you may simply want to do deals using trade credits, and that's great. We'll help you. You may not even be involved in the wholesaling process, and you might prefer just to refer deals to us and be a promoter, in which case that's also great. But the people I'm really looking for at the present time are people who want to become real estate business investment partners. I'm not interested just to have a small operation. I want to build a large operation. And the same should go for you in your business plan. When I was a government planner, we had an enormous sign across one wall in our office, and it basically said, Make no small plans. On the other end of the corridor was an equally large photo spread across the entire wall. It's a photo of an expressway with a sign that said, "Stop, go back, you're going the wrong way." Now this is the way to go. You have to start with a compliant business plan. If you don't have a business plan, how do you get in? How do you get access to $1 million worth of trade credits? And you need a C Corp, not an LLC, not an S Corp. It will cost you about $500 for a C Corp, and there is a way I want you to go about that. Initially, you'll pay $200 deposit, and this will facilitate structuring and the allocation of trade credits for your first deal. Now, you're certainly not going to need $1 million worth of trade credits for your first deal, but you could use possibly 100 grand. How much and how we capitalise your business will be done on a case-by-case basis, depending on what your business plan says. After you've paid your deposit, you'll receive a link through which to complete the purchase of the balance owing for your C Corp, which is going to be less than $300. The actual amount varies depending on the state filing fees, which is different for each state. Trade credits is for real estate. You can now get all the money you need to fund your deals, and when you're ready to proceed, you merely send an email to Vesta Real Estate